Hello, welcome back to ATRE. In this video, I'll be reviewing a very basic real estate investment trust, or REIT, valuation model I built to value global self-storage with the ticker SELF. I chose SELF because it has relatively few assets, has a straightforward capital and debt structure, and is a self-storage REIT. I figured it would be easiest to start my REIT valuation series with a self-storage REIT due to its relatively straightforward revenue and expense forecasting. Regarding the valuation method, I'm using a discounted cash flow model, which is my preferred method of valuation in nearly all cases. However, I do use an adjusted funds from operations, or AFFO, multiple to calculate terminal value, as well as the perpetuity method. But before I dive into valuation, I think it would be helpful to discuss how the model works at a high level. Because there are relatively few assets in global self-storage, and because those assets were individually acquired, it's possible to calculate an implied cap rate for the same store portfolio. I think it's important to use a cap rate to understand growth because the value of the same store portfolio can change year to year, most commonly due to acquisition, but also due to construction and repairs for certain properties. SELF defines same-store properties as consisting of only those stores owned and operated on a stabilized basis at the beginning and at the end of the applicable periods presented, or from January 1st to December 31st. We consider a store to be stabilized once it has achieved an occupancy rate that we believe is representative of similar self-storage assets in the applicable market and have not been significantly damaged by natural disaster or undergone significant renovation or expansion. Effectively, this means that using the acquisition price as our value for the properties, we should see our implied cap rate grow as revenues grow, while the value of the same store portfolio, determined by acquisition price, remains the same. So that is the valuation philosophy I use to value SELF. In a stable year, such as between 2018 and 2019, same-store implied cap rates grew by about 50 basis points. Assuming that growth will slow due to recessionary factors, I grew the cap rate of the same-store portfolio by 3% to forecast the company's NOI growth. Of course, the ability to grow same-store NOI through the cap rate assumption is suitable for SELF because I am forecasting that the company will make 0 acquisitions in the next 5 years. I couldn't find any investor calls, so I'm assuming that all the information relating to future property acquisitions is within the company's annual and quarterly reports. But as you can see, SELF has only made 1 acquisition since 2019, and with the company paying down its revolver last year, I don't foresee the firm leveraging more debt and acquiring new assets anytime soon. There is the possibility that SELF issues common shares and uses cash to buy new assets, similar to the acquisition of the Clinton and Millbrook properties. But without any further guidance from the company, I think that such an acquisition is unlikely. One of the nice things about a REIT of this size is that it can effectively be valued like a real estate property alongside an understanding of the 3 statements. Moving on to the income statement, rental income is forecasted through the portfolio tab. Other property income and management fee income, both a relatively small and consistent percentage of rental income, are forecasted as such. Expenses take a similar strategy, forecasted as a percentage of total revenues besides depreciation and amortization. Now, with other REITs, it's possible to estimate the average life of assets in the REIT's portfolio, use the average life to forecast depreciation, and then include depreciation as part of the 3 statements. But SELF is also amortizing existing leases, which make it very difficult to depreciate with a depreciation schedule. Fortunately, I'm assuming that the company isn't acquiring any further assets. Therefore, depreciation and amortization stay relatively constant. The other major expense I'm forecasting is interest expense. Interest expense is modeled out in the Debt Schedule tab. Historically, global self-storage was funded by a note issued in 2016, which had an IO period of 2 years and a revolver opened in 2018 and funded in 2019, largely used to fund the purchase of the Henrietta property in 2019. The firm not only pays interest on the debt, but also incurs procurement costs, which are amortized over the course of the loan. For the revolver, loan procurement costs are amortized over 3 years. I assume that just as the firm did in 2022, Self will continue to pay to keep its revolving line of credit open. In a smart move by management, Self paid down its revolver at the end of 2021, paying the minimum interest rate at the time. You can see that assuming a LIBOR curve as of January 2023, interest payments for the revolver would be much higher today. Moving on to the cash flow statement and balance sheet, I use the cash flow statement to drive the balance sheet. To me, that just makes the most sense. Cash flow from operating activities requires the most forecasting, largely due to stock-based compensation, unrealized gain on marketable securities, and prepaid expenses and other assets. These are not directly tied to another line item, so I try to realize patterns or maintain the same pattern in cash flows. In terms of cash flow from investing activities, forecasting is fairly straightforward due to my assumption that the firm is not acquiring any further properties in the next 5 years. Construction and improvements are forecasted as an average over stabilized years, or years where the firm didn't acquire additional properties. Cash flow from financing activities is largely derived from the debt schedule I reviewed earlier, besides issuance of common stock and dividends paid. I'm assuming that no further common stock will be issued by the company. Regarding dividends, I assume that the firm will continue to maintain its quarterly dividend as declared in the fourth quarter of 2022, which comes out to 29 cents per share per year. Moving on to the balance sheet, for major items, real estate assets are last year's asset value less depreciation. As I noted, I'm using the cash flow statement to drive the balance sheet, so cash and cash equivalents are pulled directly from the cash flow statement. Other line items are driven by the cash flow statement. I kept goodwill constant because the firm hasn't been amortizing goodwill in the past. The liabilities in this instance are fairly standard. Finally, valuation. I use a discounted cash flow method to calculate the fair value of the company, using both the perpetuity method and an AFFO multiple to calculate terminal value in year 5. Now the share price and therefore the AFFO multiple are volatile. I'm assuming that the fair AFFO multiple is around 15. Regarding discount rates used to calculate terminal value with the perpetuity method, I used what I believe will be a fair cap rate used to evaluate the property portfolio in 5 years. I used a cap rate because investors are already baking in growth and risk-free rates in their property valuations. So if I use a cap rate, I don't have to assume a growth rate or forecast where the treasury rates will be 5 years from now. Today, the share price of Self is around $5 a share. You can see that using the perpetuity method, the model with current assumptions values Self at $4.92 a share, while it values Self at $4.72 a share using the AFFO multiple to calculate terminal value. I also valued the firm with a net asset value, or the capitalized property less total liabilities. I capped NOI at 6.5%, which I believe is conservative but in line with the company's historical dividend yields. As you can see, the NAV per share is calculated as $7.09, meaning that we could buy Self at a steep discount to net asset value. I hope you found this video helpful. I'll be working on a few different REITs going forward. Thanks for watching.